Yeah, 1
Very
hour.
good. Yeah. The reason why I ask is I discovered, or actually my co-author discovered some version of the program where it was half an hour.
Yeah.
But the most recent version I have is an hour. So we started having some doubt. But good, an hour is fine. Yeah. I have 19 slides. I'm sure I'll get through it.
Okay, good. Yeah, just 1 hour and the remaining time for Q&A or discussion or something. Yeah.
Very good.
Yeah.
So you're all based in Vietnam?
Yes. Yeah, currently
There are some other from overseas as well.
Mm-hmm.
How are you there? That the situation is better there? That all the restriction had been removed?
Are you talking about the COVID?
Yeah.
It has improved. So, but I have been working from home actually first since we locked down here the 21st of March in 2020.
Yeah.
I was allowed back in my office in last month. Some other people could go a bit earlier, but so now people are starting to go back to work. The restrictions have been relaxed, so life is somewhat starting to become a bit more normal. This being said, because of that, the infection rate has started to go up a bit again. So we since they relaxed the lockdown, which was in June, things have gone up a bit, but the mortality has remained low because most people are vaccinated. About 80% of the population is double vaccinated. And it seems that, the chance of dying if you're double vaccinated has become quite small, but there are still lots of people who are getting infected and who may get ill and stuff like that. So we are not out of the woods yet. And I fear that with schools reopening, so schools start again, I'm talking about primary schools, secondary schools, they open again beginning of September. Kids will start going back to school, and that will again spread the virus more. Then winter will start to come, which means people will be more inside. And so I think it will get worse in winter again before it gets better. But hopefully, because there is less mortality, hopefully things will be able to carry on somewhat normally, because yes, we were locked in for so long. I hope we won't have that again. I don't know, what is it in Vietnam now? I know that initially you did really well and that you managed to contain it because you have some past experience with SARS, I believe, but I'm not sure whether it's still so good now.
The situation is like, it varies between different provinces. Like in Ho Chi Minh City, the situation is getting better, but it's still in a very bad situation with the very high infection rate every day. And the government tried to speed up the vaccination program for the people in Ho Chi Minh City and other southern provinces. But it's expected that further lockdown for 2 more weeks will improve the situation.
Yeah, and, because some of these countries in South Asia, sorry.
Yeah, you can go on, sorry.
Some of the countries in Southeast Asia and Vietnam in particular, but also South Korea and so on, were given initially as an example of how to deal with COVID in terms of, containing it. Because initially, the Western countries were in very bad shape, right? It started in Italy here in Europe, and then it spread all over Europe, and it was terrible. March, April, May 2020, we were really in dire straits, whereas in Korea, South Korea, and a number of other Asian countries, they managed really well. And people here said, well, they've had SARS in the past, and they know how to deal with things like that. And I thought Vietnam also fell in that category. But you're saying now actually that perhaps, and that might be perhaps because you haven't vaccinated as much, I guess.
I see, but it seemed to me that like the only way here is try to lock down and try to contain the situation and try to, you know, to improve the medical system by building more hospital in order to reduce the death rate, and that is the first priority. And I don't see much communication nowadays from government or what to go after that. Like the saying, the so-called dual goal that had been spoken for a while from various government officials. Now they keep quiet on saying what's going on next, what they are going to do next. I think that like they put more effort on now. We try to contain the virus first, and like people like us, you know, like we do not hear much what they are going to do after that. Like still the problem with the planning, it's not only in Vietnam, but I think that like in other Asian countries, like Singapore and Korea, it's like they now they can contain the situation even though the infection rates keep going on, but they already have very clear economic policy in place in order to deal with the situation and in and after the COVID period.
What is the vaccination rate in Vietnam?
It's still very, very low. Tuan, you have the number? I think it's still
less than 10, I think.
Yeah,
less
around
than
10%. We
Yeah.
still
Oh.
need like around more than 100 million people, 100 million. We need around 200 million doses to fully vaccinated, but it's now like 27 or 26 million doses, I think, that right?
Yeah, that's true. Yeah, I think the rate is quite
So-
low.
I
Because
see. that may be
because we need to wait for the sponsor and also like some ordering packages vaccination from
But
the
the good news is like the government seem to approve a local company in producing vaccine, Nanovax, right? A few days ago, they give a green light for the company to mass produce. Probably we expect that will be in effect for in a month or two, right? They are in the final stage of testing now. I think I like
and
3
which vaccine
phase,
is that?
but they already go to the third phase already, right? 3A phase.
Which vaccine is it that will it be like your own produced, or is it AstraZeneca or the Pfizer, or which one are you using?
Yeah, AG is I think that is the largest proportion, right, among 27 million doses that we received. At least 18 or 19 million doses from AG, and some Pfizer and Moderna. I think around 5 million ton. I think I'm not up to date with the number, but about that ratio.
5
and
5 million.
Around 1 or 2 million from Sinopharm, the Chinese vaccine.
Okay, and the one you produce locally that's been approved, is that going to be a different one, your own, or is it just that you have a license to produce, say, the Pfizer one, or?
No. I think that the Vietnamese one, they developed their own type vaccine. And some other firm, they purchased the license from other firm.
Pfizer, I think.
Yeah, from Pfizer. They purchased the license to produce in Vietnam. That is the second approach. It seems like people in the rush to get more vaccine for Vietnam. That so-called vaccine diplomatic approach.
How will you run the keynote? So do I just give my talk and then questions come as we talk, or questions come at the end, or there will be the chat involved, or how will it be run?
Okay, so wait a moment. After 2 minutes, then our team will introduce the moderator, Professor Võ Xuân Vinh. Then after the Professor Võ Xuân Vinh take over the stage, then he will introduce about your biography and your information. Then after that, you can deliver the talk in 1 hour more or less. And after that, Professor Võ Xuân Vinh will moderate, will invite the participant, also read the questions in the chat box, and also like moderate the Q&A section. So I think it's like how we proceed with the keynote speech. Yeah, thanks.
Yeah.
So we just have 1 minute, and then we can start the keynote speech in the afternoon today.
So you can see my screen well now, right? It's full screen.
Yes. Yeah.
Good.
Full screen. Excellent. Yeah.
If something were to happen with the internet connection, I will switch to my mobile phone, which uses the satellite, and then my co-author would just do the slides on her end. I hope that won't happen, but you never know.
Yeah.
So I would have to, yeah.
Okay.
So I would talk through the mobile, but hope it won't happen. Hopefully not.
Yeah.
But you never know.
Yeah, the chance is low, I hope. So, okay, ladies and gentlemen, thank you a lot. Then now I invite my colleagues, Khánh Hoàng will manage the stage and introduce Professor Vinh.
Right. Thank you everyone for attending, for coming back to our conference with the keynote sessions. And now I would like to introduce Professor Võ Xuân Vinh from the University of Economics, Ho Chi Minh City, to be the moderators of the keynote speak. And please, Professor.
Thank you very much, Ton and Khánh Hoàng. Good afternoon, everyone. My name is Vinh from the University of Economics, Ho Chi Minh City. First of all, I would like to take the opportunity to thank the conference organizing team for their hard work in making an interesting conference. It is my pleasure to be here today to moderate the keynote speech. The keynote speaker is Professor Bart Lambrecht. He is Professor of Finance, Jewish Business School, University of Cambridge. He is Director of the Cambridge Center for Finance, Director of the Cambridge Endowment for Research in Finance, and he's also a research fellow of the Center for Economic Policy Research. He had very active academic career. He has served in several editorial roles in top-tier finance journal. He's a former editor of the Journal of Corporate Finance, an associate editor of the Journal of Banking and Finance, and a member of the editorial board of the Journal of Business Finance and Accounting. He is a former associate editor of the Review of Finance and Financial Management. Prior to joining Cambridge Jewish Business School, Professor Lambrecht was a professor at the University of Lancaster and a senior lecturer of the University of Cambridge. He has held visiting positions at the University of Calgary, MIT, and UCLA. For today's keynote speech, he will talk about the topic entitled "The Dynamic of Financial Policy and Group Decision in Private Firms." Since we have quite a lot of time, we have an hour and a half till the end. So the speakers, you can take about an hour to talk, and then we will follow by the Q&A and discussion. Ladies and gentlemen, please join me in welcome Professor Bart Lambrecht to the keynote speech today. Please, Bart.
Thank you very much, and thank you so much for inviting me to give this keynote. It's a real honor and a pleasure to be here for the third Asia Conference on Business and Economic Studies. So thank you so much. The paper I'm going to present is a corporate finance paper, and it's all about financial policies of private firms. Now, if you look at the corporate finance literature, probably, 95% of the literature would be on public corporations. People have studied the capital structure of public corporations, that is how they are being financed. People have looked at and studied investment policies of public corporations. And so there is this massive literature. Now, admittedly, public corporations, in terms of value and market capitalizations, are obviously huge compared to small firms and private firms. But if you look at it merely in terms of numbers, private companies vastly outnumber public corporations. And yet, there is relatively little work that has been done on private firms. That's partially been because of lack of access to data, but it's less clear why on a theoretical front. For instance, we've done much less on private firms than on public firms. And so this paper tries to kind of make some progress in studying private firms. Now, private firms come in all shapes and forms. There are, and that is legal entities I'm talking about. They could be private limited companies, limited liability companies, sole proprietorships, various type of partnerships. And these legal structures would depend from country to country. So there is really a whole variety of type of private firms, but we won't go much into the legal details of that. And so we are thinking here about a generic private firm. And once you think in those terms, then there are really two key characteristics that distinguish private companies from public corporations. The first one is that private firms are usually owned by a small group of investors. Yeah, it could be one, the sole proprietorship, or a few, or perhaps a dozen, but you're talking about typically a small number, definitely when you compare it with a public corporation where the shares are being held by thousands of shareholders. And obviously, given that you're talking about a small group of people, that will have certain implications for the way the firm is being run. And that's one particular thing we are going to look at. Another key defining characteristic of private firms compared to public corporations is that the shares of private companies are not publicly traded. Publicly traded firms have their shares traded on an exchange, and that means these shares are very liquid. If I hold shares in IBM, then I can sell them at any point in time. If you have shares in a private firm, they are not traded. And often it may be very hard to get your money out of that firm. Most private companies, the investments is highly liquid. If money has been invested and getting it back is pretty difficult. And usually in some legal structures, it will be very well defined and specified contractually under what conditions one could try to dissolve the partnership or the firm, and what the terms would be if you wanted to get some of your money back. And so this illiquidity is quite a key feature, and that's something that we would like to study a bit more too. Now, going back to the group nature of private firms and the way it's run, there are some experimental studies in the literature out there that have shown that groups act very differently compared to individuals. Now, these experimental studies have obviously been done in labs, and they have tried to model group behavior. And the group behavior kind of was proposed by two competing hypotheses that come from sociology. The first hypothesis is the so-called diversification hypothesis. And that hypothesis says that group decisions are kind of an average, a weighted average of the decisions that the individuals would like to make. Yeah, so if, say, for instance, my co-author of this paper, Shiki Chen from Cambridge, if suppose we have a firm together and Shiki would want to invest 0 and I want to invest 100, then typically the diversification hypothesis would say, well, we'll come to a compromise. some average. So say we'll invest 50, somewhere in the middle. Or if perhaps I have a little bit more weight in the decision making, perhaps we'll invest 60, but it's going to be somewhere between 0 and 100. There is an alternative hypothesis called the group shift hypothesis, which argues that actually in groups you may get something that is called polarization. And what that means is that often in groups you may get polarized views, whereby there are certain dominant characters in the group, and they are going to, with extreme views, and it's these extreme views that are going to dominate. So going back to the example, say, between my co-author Shike and I, suppose for some reason I'm the more dominant person, I could perhaps have such a dominant position that basically I just say, well, you want to invest nothing, I want to invest 100, it's going to be 100 because I believe that's the right thing to do. And I put forward some very forceful kind of argument, and you get kind of polarization. And these are kind of the two competing hypotheses. The diversification hypothesis seems to carry quite a lot of weight empirically, and also finance people have done some empirical tests on this. But still, there are some things that the diversification hypothesis can't explain. And that's why, for instance, in extreme situation, think about, say, market crashes or bubbles, market booms, why actually groups tend to act more risk averse than the average individual in high risk situation. So like when you have a market crash, everyone is heading towards the door. Yeah, everyone wants to sell, and you get like extreme fear. Everyone becomes fearful and just wants to get out. And so the group the herd starts behaving in a very extreme fearful way. Whereas, say, another example would be that in low risk situations, when you have almost like a bubble or the market is steaming ahead, everyone is jumping on the bandwagon, and people actually are not fearful anymore and are just kind of throwing money into the market or whatever kind of looks like a .com firm, or now a green energy firm, whatever kind of looks fancy, people just jump on the bandwagon. So, and that's something, of course, that the diversification hypothesis can't explain, but that the group shift hypothesis can explain. Now, our model will kind of surprisingly encompass both hypotheses, and both, it will primarily be a diversification argument we'll have, but we'll see that in extreme situation, you can start shifting towards the behavior of the most risk-averse individual or the preferred behavior of the least risk-averse individual. So what we are going to do in the paper is we are going to look at the investment, financing, and payout policies of a firm that is run by a small group of undiversified investors. Think about it. If you invest in a private firm, you know, you go in a partnership with perhaps your brother or a family member, typically most of your money is going to be in there. So this is not like dipping into the stock market. You're going to be highly undiversified. And so investors are undiversified, and they also have heterogeneous risk preferences. And that's a key ingredient in the model. People have different preferences. Some are very risk averse, others are less so. And they will have to come to some kind of a mutual agreement about how to run this firm in terms of the capital structure, in terms of the investment policy. Now, normally, if you could trade your share in the firm, risk aversion might be much less of an issue, and diversion of preferences might not be a big deal, because look, if I have a partnership, say, with Shiki, and we both disagree, well, you know, if we could sell our shares in the firm, we just move on and, you know, we do something else. So you just sell your stake and you move on. But with a private firm, you can't do that. You're kind of really stuck, so to speak. And how are you then going to reconcile differences in preferences? Yeah. If I normally would feel things are getting too risky, I could sell a little bit of my stake in the firm and invest it in a safe asset, and that would kind of rebalance my risk. Here, because I'm undiversified and I can't sell, you know, how do I deal with it? And then another question that is going to pop up is, how do we share group synergies? If I have a partnership with Shiki and we've got some synergies, so typically one person may contribute capital, the other person may perhaps contribute ideas or expertise, that creates synergies. Now, how are these synergies going to be shared? Between the entrepreneur who may be the one who has the original idea perhaps, and the co-investors, the people who then put in capital and may also be involved in the running. How are these synergies going to be shared, and what is going to be the effect of all that on cash flow and control rights? And all of that is really acute with private firms. With public corporations, you just buy a share and your ownership share is just proportional to the money you put in. With private firms, that's not necessarily the case. It's not because I put in 10% of the money that I'll have 10% of the shares and 10% of the votes. And so what we're going to come up with is a model that kind of tries to model, say, ownership stakes in private firms. So to summarize the objectives and research questions, we have a model. We will model the dynamics of group decision-making, where the investors and the entrepreneur in the firm have heterogeneous risk preferences. As a group, they will have to agree on one investment policy and one financing policy. And the way this is going to be set up is that's going to be very much agreed upon by consensus. They are going to decide on the investment policy, financing policy, and also the payout policies that will kind of maximize the weighted average utility of the ruling coalition. So it's not like every day they will, or for the day-to-day running, they will vote on a policy and the majority gets, no. There has to be some kind of continuity of the policy, and that means that the same group of people are going to make decisions, and therefore they will have to kind of come to a consensus and agreement. And that's why invariably all people's views and preferences will to some extent be taken into account. Now, while they have to agree on one investment and one financing policy, you know, one leverage ratio, so to speak, and one investment policy, the payout or compensation, if you like, can be tailored to the individual members. So the entrepreneur could get a different kind of compensation or payout than, say, some of the other investors. And we'll see that that payout policy could be time varying, depending on how well the firm is doing. So the contracts that we will design are going to be much more general than what you would see with public corporations. This being said, also in public corporations, you could sometimes have quite complicated option contracts for managers or warrants or convertibles. So even there, actually, you don't always have the straight vanilla ordinary equity. Now, we'll try to see then what will group members' claims look like, and they will kind of endogenously result from our modeling. And we'll also try to see how the entrepreneur will be compensated differently compared to the co-investors. So think about it. In our setting, there is an entrepreneur who has really access to the project. He's the one who either has the idea or access to the project. And the access could be under the form of a license he has, or a patent, or superior skill, or something like that. And he can benefit from extra money. He needs extra investment, and he will approach these investors who may also be involved in running the firm. Perhaps someone may have expertise on the finance side, another one may help out with production or whatever. So they can all be involved in the running, but obviously there is the initial entrepreneur who's the lead investor and sets everything up. Now, he is offering a project that is going to offer superior return compared to what the investors have before. And we assume for simplicity that before the investors just have a savings account, so they can put their money on the bank. And now suddenly there is the entrepreneur and says, hey, instead of putting your money on the bank, why don't you invest it in my company and let's talk? And then, but of course, once the entrepreneur starts talking to the investors, they will start to know about this project. And they'll be able to bargain about some of the synergies. The entrepreneur will benefit from getting capital, and at the same time, the investors will get a higher return and a savings rate. And the question then is going to be, how are these returns going to be shared? Are they going to get really as much as the return on that project, or will it be somewhere in between? And that will very much depend on the bargaining power between these co-investors and the managers. Now, we will not model that explicitly. It will be like a parameter. And it depends very much on the nature of this project. If it is just an idea, well, once you've heard the idea, you can do it yourself, and there is not much bargaining power that the entrepreneur has. If, on the other hand, the entrepreneur has a cast iron patent on the particular invention, well, then the co-investors, if they subsequently walk away, they wouldn't be able to replicate the project. The utility weights, which are going to be set, which are a bit like generalized ownership shares, are going to be very much influenced then by the bargaining power that co-investors have. And they will then ultimately expose and determine like the ownership stake you have during the lifetime of the firm, and the weight you will have in the governance of that company, and also the fraction of the cash flows you will get. And as we will see, that fraction may change over time. And then importantly, we'll also try to have a look at what is really the nature and the effect of the liquidity of private equity. We know that you can't trade these shares. Once you've put your money in the firm, it's stuck, so to speak. It's hard to get it out, unless we'll see you get it back at, say, the book value of the net asset value. And we'll look more into detail. Now, before I go into the model and the technical details, let me give you the key results of the paper, because, as I said, the next few slides will be a bit technical, and sometimes, and I want to make sure that you kind of get the key takeaway of the paper. So the first thing we'll find is that basically the investment and financing policy will be a time-varying weighted average of the individual policies. So the investment will be somewhere in between what an average of what the individual investors would like to invest in this project over time. And the leverage ratio in the firm will also be some average leverage ratio of what each individual would like. You know, the least risk-averse investor would like a high leverage ratio. And in our case, that's the entrepreneur. Most risk-averse investor would want to keep it conservative, keep a low leverage ratio, actually have cash, no debt. What we'll have is, it will be somewhere a compromise in the middle. That's perhaps not surprising. What is more interesting is that this compromise will be time varying. So the weights are going to vary over time, such that initially what will happen is that the firm will primarily be financed by cash and invest very little in the project initially. As then things go well and time moves on and the firm starts making profits, the firm will start borrowing more and starts accumulating not only more retained income, but also starts borrowing more to invest, to finance expansion. And so the leverage will start going up in good time. And so you get a pro-cyclical leverage ratio. On the other hand, if the firm starts making losses, it will start selling some of the assets, shrink the balance sheet, and leverage will start going down towards the optimal leverage level of the most risk-averse investor. So, and that kind of corresponds with the level of group risk aversion. You have the individual risk aversion, which is constant over time and dependent on the risk aversion parameter of each agent. But the risk aversion of the group as a whole will be time varying. When times are really good, group risk aversion will decline and the group will not be fearful. But as times get worse and the firm starts making losses, the group risk aversion will become higher and higher, and will start moving towards the risk aversion level of the most risk averse agent. So the firm will start behaving more and more like the most risk averse agent would run the firm. Now the payout is be dependent on the level of risk aversion. So the payout to the least risk averse investor will be convex in net worth. And it looks very much like a straightforward equity contract. When things go well, that least risk averse investor, who will be the entrepreneur, will capture all the upside. But when things go bad, he won't get anything. The payout to the most risk averse investor will be like a concave function. When the first money starts coming in, he will be benefiting from it. And in bad times, he will get some income. So he will be protected on the downside. On the other hand, as things start going well and well, the payoff of the most risk averse investor will be capped. And all the upside will gradually start going to the less risk averse investors. And for the intermediate investors, so with intermediate risk aversion level, the payout will be S-shaped, like preferred stock. And they all will have a cap to their payout, and the cap will go up as you're less and less risk averse. And I will show that with a graph later, so it will become more clear. So what we'll get is kind of a mix of all kinds of contracts. So if you look at the balance sheet on the liability side, we will have debt there, but we will also have equity, and then contracts that look like preferred equity. And these kind of contracts will allow for efficient risk sharing. And why do we have this variety of contracts? Well, that's really a result of the fact that investors can't trade in their stock. Normally, they would kind of balance their risk by buying and selling stocks in that company. They can't do that. So the only way now to reconcile their risk preferences with the policies of the firm is to have dynamic contracts, whereby their cash flows get dynamically adjusted over time, dependent on how the risk and the fortunes of the company evolve. Yeah, so it's this dynamic rebalancing. It's kind of a substitute for investors being able to buy and sell shares in the company. Now, when the investors join the firm, there's going to be a unique set of utility weights that will satisfy their participation constraint. And these utility weights resemble somewhat ownership shares, but they are generalized ownership shares because they are only proportional to the capital that investors invest if everyone has locked utility. If everyone has locked utility, then these utility weights look exactly like the ownership shares you might see in public corporations, in the sense that if I invest 10% of the capital, I get 10% of the shares. But in general, when investors don't have locked utility, these utility weights or generalized ownership shares are not only going to depend on the amount you invest, but also on your risk preferences and on all the various parameters in the model, like volatility, the Sharpe ratio of the project. So they are quite complicated expressions. They are going to be non-linear in the capital contributed. So it's not because I contribute 10%, an extra 10% of capital that I will get an extra 10% of the shares and the cash flow rights. Interestingly, also, the co-investors are going to acquire the net worth stake in the company at a premium. So it means that as a co-investor, if I put 10 million in the firm, my claim in the net worth of the firm, like the book value of the firm, is going to be less than 10 million. It might be only worth 6 million. So I'm kind of buying the net worth at a premium. So it's a bit like paying a joining fee. I pay 10 million to acquire 8 million net worth in the firm. And who is getting that joining fee? The entrepreneur. He is actually going to be able to acquire net worth at a discount. Yeah, and that's where the bargaining power comes in. Now, you might say, well, why will the co-investors want to do that? Well, although they pay a joining fee, a discount, they expect that for that net worth, they will get a higher return than what they could get by putting their money in a bank account. So although initially perhaps there might be a cut in their consumption, they expect that over time there is going to be a growth because they are investing in a superior asset that will give superior returns. It's a bit like, you know, joining a mutual fund. When you join, you typically have to pay 3%, say, joining fee. So you invest 100, but you only get 97 in the mutual fund, and 3% is gone, and it's being paid to the management of the fee. But you hope that for that 3%, you are going to get some higher return. In practice might not always be the case, but at least that's the idea. So one comes now with a mutual fund. Once I've acquired my my share in the fund, if the fund is traded, I can sell it subsequently at the price. I can sell my stake easily, but with private equity, you can't. If I want to get my money out, I put in 10 million. I could get out only my net worth, perhaps, which would be 8 million, if I'm allowed to do so, even because the money may be invested. Might not even be possible to get my 8 million back. But we'll see that the net worth claim will be at a discount. If it's like the difference between book value and market value, the market value would be higher if I could sell it because it's going to be the present value of all future income, but the book value is much lower. And because I can't monetize it in terms of market value terms, I would have to get out at a discount. And that means that co-investors are locked in. Even if they could get their money out and could kind of start liquidating some of these assets, they wouldn't want to do it because they would be giving up these extra returns that they hope that they have already paid for up front. Now, the related literature, I'm going to be quick here. There's a literature on dynamic group making, small ones. There's literature on entrepreneurial finance. There are some old literature, old papers on partnerships and risk sharing. And then, of course, the literature on asset pricing with heterogeneous agents. Our paper touches on all of these, but obviously combines elements from different literatures here and comes up with new results. So let me show you a little bit of the technical detail now of the paper. So we've got a model whereby there is one entrepreneur, the lead investor, so to speak, and N-1 co-investors who start up a private firm. Every investor contributes a net wealth of WI0. So 0 here is time 0. I is the contribution of investor I. And the total net worth contributions add up to the initial equity capital of that private firm. That can then be invested in a risky project. And these are the risky assets. And they have a return which is driven by, they are normally distributed returns, similar to here an arithmetic Brownian motion. So this is like a Brownian motion, it's a random shock, and there is a drift term. Mu is the expected return, mu1, and the 1 is the subscript 1 linked to the entrepreneur. It's really a return that can be generated by the entrepreneur because he has this superior asset. And the volatility of the project is sigma 1. Alternatively, everyone could also invest in the savings account or borrow at the risk-free rate R. We'll see that our firm will actually remain risk-free even if it takes on debt. So if D is positive, the firm has debt. If D goes negative, it means that the firm has a net cash position. So this translates into a balance sheet where we have assets equal to equity capital plus debt. Here, the equity capital is the equity, the net worth contributed by the investors, and D is the residual. As I said initially, so it could be like a line of credit. As I said initially, D could be negative, which means that the net worth is invested in the risky project and partially in cash. So initially there could be a cash holding and no debt. Over time then, what will happen is the net worth is going to be evolved according to the net worth the budget constraint. So changes in the net worth will come from changes in the assets value minus changes in the value of the debt minus payout to all the investors. So obviously when you pay out cash to the investors, that's going to drain your net worth, yeah, because you're distributing it back. You can see here that the payout is indexed by I, which means that the payout can be specific to each investor. So it's not like with a standard public corporation that everyone gets the same dividend. Here we can give a compensation, a payout that is specific to each individual. Now, what we ultimately will be focusing on is a key decision variable is going to be the asset to net worth ratio, which we call omega, subscript T. That's a bit similar to like a leverage ratio. How much net worth do I have in relation to the assets? So how much equity financing compared to the assets in the firm? And that's, of course, a decision that the investors jointly will have to make. The investors are all risk averse and have a power utility with a constant coefficient of relative risk aversion given by gamma I. Gamma I is obviously positive. So the investors all have a constant relative risk aversion, but we'll see that the group as a whole, their risk aversion will not be constant. It will be time varying. The lead investor is the entrepreneur, and we assume that he's the least risk averse without a lot of generality. And then the other investors kind of have increasingly more risk averse, and they have a subjective discount rate growth, which is going to be bigger than the risk-free discount rate. Now, they're going to, as a group, maximize the weighted lifetime utility of the investors. So if you look at this integral here, what this is it's the integral of the utility over the lifetime of the investor. And we assume that the investor lives forever. So it's an integral up to infinity. And then we are going to weight that by some lambda I, which is the utility weight attached to that investor. So investors with a higher utility weight are going to have a higher say, so to speak, in the decision-making process. And the decision-making is with respect to the investment policy, which is how many assets do I want to purchase compared to the equity I have, the asset to net worth ratio, and then with respect to the payout policy, how much payout will each investor going to get? And so it's basically a weighted average of the lifetime utility of each investor. Ji is simply the lifetime utility of each investor here, and it's going to be weighted. As we will show later, is these lambda weights for log utility will just correspond to ownership stakes. If I have 10% of the capital, then I will have 10% weight. But in general, that won't be the case. This will have to be solved subject to this budget constraint, and it will have to be solved also to the co-investors participation constraint. Co-investors will have to be happy to contribute their capital. And I'll say a little bit about this now. So what are these participation constraints? Well, the entrepreneur is the lead investor. He controls access to the firm's technology, and he can generate an asset that has a Sharpe ratio of psi1. And the Sharpe ratio is basically the excess return over the risk-free return divided by the volatility. So this ratio here, if you can see my cursor. He has access to that superior asset, and he could just run it on his own and generate a lifetime utility that corresponds to this expectation here, corresponding to that Sharpe ratio. But obviously, he only has a limited amount of capital. And so this may be, not that high lifetime utility. Particularly if he has no capital, his lifetime utility on his own would be zero. So to some extent, he will want to attract capital from other co-investors. Now, these co-investors initially only have a savings account, so they can just put it and invest it at the interest rate R. But once they start getting involved with that lead investor, with that entrepreneur, they will start knowing what this project is about. And through the bargaining process, they would be able to achieve now a Sharpe ratio psi, potentially by running that project themselves. But this psi is going to be less than what they could achieve with the cooperation of the entrepreneur. So that will give them a reason to join still the firm. So the psi will kind of determine the reservation utility that that co-investors will have. It's the kind of lifetime utility they could achieve on their own, given that they could generate kind of a return determined by this Sharpe ratio psi. So the entrepreneur therefore will have to set utility weights, ownership stakes, such that the investors will be indifferent between joining the firm and getting a lifetime utility JI. Remember, this is the lifetime utility they get here from joining the firm, and the lifetime utility they could get on their own. Yeah, because otherwise they will not want to join. So, and obviously it will be determined by this bargaining parameter. If psi is zero, then they have no bargaining power and they will just get basically the risk-free return, so to speak. If they have all the bargaining power, because the investors say the entrepreneur has no capital whatsoever and desperately needs them, and also it's just an ID which the other investors could replicate, then they will effectively be able to achieve psi 1, the same return as the lead investor. And then finally, obviously, all the net worth contributed by the investors will add up to the net worth of the private firm. And so this basically now summarizes the whole problem mathematically. So this is the objective function, and these are all the constraints, the participation constraints here, and this is a transversality condition. Now the next slide will show you lots of formulas. I will just briefly show you, but then I will talk about it and in words and pictures. But this is basically the solution to the problem, and it's all closed form. So this shows you here the optimal investment policy, which is the asset to net worth ratio that is going to be adopted by the firm. And it's going to be a bit like a leverage ratio, so to speak, but it's not going to be constant. It's going to be time varying. What it corresponds to, it's basically like the Merton ratio, but a weighted average of that. Here, this is basically the policy that investor I would like to adopt, given that he now has access to this superior project. But it's not going to be investor I, it's going to be a weighted average of the investment policies of each investor, where these are the weights here. But these weights are going to be time varying. They will depend on some stochastic variable Z, which is going to be linked to the net worth of the firm. Z is a little bit like a log transformation, so to speak, of the net worth. It's a change of variable just to be able to express everything explicitly here. So what we have is a time varying investment policy that is a weighted average of the individual policies. Likewise, the payout policy, the consumption policy, is going to be time varying and will depend on the investor's preferences. So each investor will have a different payout function, and it will be time varying, driven by the net worth of the firm. Now, let me say a little bit more in words now what all of this means. So first of all, this investment policy, this omega function, which is the asset to net worth ratio, that ratio is going to be procyclical. As the firm is doing well, and is making more and more profits, we will start cranking up that ratio. And that means also that the net debt ratio will become procyclical. As the firm is doing well, I will start borrowing more in order to fund the extra investment. On the other hand, when things are going badly, I will start contracting my balance sheet. I will start disinvesting and use the proceeds from the disinvestment to pay down the debt. So what that means is that basically this omega, this investment policy, can vary between the policy of the most risk-averse agent, which will be the one in very bad times when the firm is loss-making, towards the investment policy of the least risk-averse agent, which is the most aggressive one, which will happen in good times. And so the capital structure or leverage ratio will also likewise be time varying. Typically, in standard theories of capital structure, there is a target policy. Yeah, constant leverage ratio. We will not have that. The leverage ratio will vary over the life cycle of the firm. Initially, it may start off with a negative net debt ratio, where the firm has cash and no debt, and then over the life cycle, we start building up debt. It's only when all the investors have the same risk preferences that basically the policies will become stationary. If everyone has the same preferences, we will have a constant target ratio, constant target leverage ratio. When the risk preferences are different, then that's not going to be the case. The group level of risk aversion can be captured here by the coefficients of relative risk aversion of the group, and it's going to be the Sharpe ratio of the asset divided by the volatility of the asset. These are constant numbers, but it's also divided here by this asset to net worth ratio, which, as we know, is procyclical. That means that as the wealth of the firm goes up, the risk aversion of the group goes down, and it will converge to the risk aversion level of the entrepreneur, the least risk averse agent. As the firm starts making losses and the net worth goes down, or the Z variable goes to minus infinity, the coefficient of risk aversion of the group will go towards the one of the most risk averse agent. Now, payout is going to be a convex function of total net worth for the most risk averse agent, and it's going to be a concave function for the most risk-averse agent. For anyone else, it's going to be somewhere like an S-shaped function, and I'll show that in a second, really. It's going to be linear payout only if everyone has the same coefficient of risk aversion. Then they start looking a bit like straightforward equity contracts. Otherwise, we have quite complicated kind of contracts on the balance sheet. This is here the monetary certainty equivalent of each investor's claim. So if the firm has a net worth of, say, 100, how would that be shared among the investors? And this is the formula for it. And it's going to highly depend on risk aversion and on the net worth level again. And again, these claims will look, the least risk averse one will have something that looks like an equity contract. The other ones will have something that looks more like a preferred stock contract. And these will follow endogenously out of our model here. These are the formulas for it. And I'll plot those out here. So this shows you here the claim values that the investors have in the firm, the contracts. Now, this is for 4 investors, and they each have a different level of risk aversion. Gamma 1 is the least risk averse agent. He has a coefficient of risk aversion of 0.8. And gamma 4 is the most risk averse agent. He has a risk aversion coefficient of 9. This is here the claim value they have as a function of net worth. Now, the least risk averse agent, he has this blue dotted curve here, and you can see it looks like an equity claim. For 0 net worth, he has 0 equity, and then it's a convex increasing function. Initially, he has very little equity, almost nothing, but then he's the one who captures all the upside. This curve here, strictly concave curve, is the one of the most risk-averse agent. when the first, and it starts off on a 45-degree line, which means that the first dollar goes in his pocket. The second dollar of net worth will almost entirely accrue to him too, but gradually as the firm accumulates net worth, he will get less and less, and it will actually be capped at some top value. Then this curve here, the yellow one, dashed one, is the one of the second least risk averse agent. Initially he gets very little, but then gradually starts sharing in a convex way, and then it gradually becomes concave and tails off to a cap. And this is the curve of the third investor. And you can see that all of them here are having a cap, except for the least risk averse agent, whose claim is uncapped, meaning that as this firm starts doing really, really well, he will start capturing all the upside. And that's what the entrepreneur will get. He will cream off most of the upside here when the firm is doing really well. Now, this shows us here the utility weights. The utility weight for investor I, this is for the co-investors from 2 to N, and this is the utility weight of investor 1, the entrepreneur. Now you can see that utility weights of the co-investors is increasing in the amount of capital they contribute. If you contribute more capital, you get a higher weight, but it's non-linear in gamma, in the coefficient of risk aversion, unless gamma is 1. Gamma equal to 1 is lock utility. If gamma is 1, then basically it becomes linear in wealth. And if basically everyone has lock utility, then the utility weights are just proportional to the wealth you contribute, the way we usually tend to think. But in general, it's not so simple. It depends on all these parameters here and on the, so it's highly nonlinear. The other thing you can see is that if the co-investors contribute 0, they will get 0 weight. That makes sense. The interesting thing is that if the lead investor, entrepreneur, contributes 0, that's his contribution, he will not have a 0 weight. He will still get some weight in the firm. He will still get some shares. And that's because of the fact that he is the one who has the project, who has access to this superior asset. And this is here the net worth he will contribute merely from collecting fees, so to speak, from these co-investors. 1 minus this here is always a positive number, and it's going to be multiplied by the contribution of investor I, and this represents kind of the fee that investor I has to contribute in order to be allowed to invest in this private equity. And it will generate it's like a private equity premium. To get access to this special project, you have to pay a premium, so to speak. And that means that even if this entrepreneur doesn't contribute anything, he will still have a stake in the firm exposed. These premiums here, we can actually calculate a formula for them. This is the net worth premium for investor I, and it's basically going to be a negative number. This is the amount that I contribute as an investor, WIO, and this is the net worth claim I have, a bit like the book value in this company, my share of the net asset value. And it's going to be a negative number, meaning that I'm putting in, say, 10 million of capital, and the book value stake I have is only, say, 8 million. The entrepreneur, he will actually acquire the net asset value at a discount, because he will get basically his net worth and then all the other contribution by all the other investors. So he has a premium here. He acquires everything at discount, and therefore he starts off with an advantage. Now, as I said, the co-investors are very much locked into the firm, because this is their net worth stake they have, this W tilde. Now, suppose they pulled it out of the firm, if they could do so. It may not be easy, because it may be invested in a liquid asset. But suppose they could, if they got their money out and then they invested it on their own it would be less than what they could generate in the firm. And the reason for that is that they cannot make a private equity asset with Sharpe ratio psi 1. They don't have access to that superior asset. They cannot do as well as what the entrepreneur can do. So once they pull out the money out of the firm, they will not be as skillful in investing it. And therefore, they have paid a fee to join in terms of getting future superior return. Then get your money out, you lose out. The same is actually not true for the entrepreneur. If he were able to pull out his money out of the firm, he would be exactly equal to what he has on his own. So if the firm were to be dissolved and he manages to get his net worth stake out, he would be indifferent. So he's not quite locked in, but he neither has an incentive to renege on the contract, so to speak. Now, this is the last slide I'm going to show you before I conclude. This gives you a numerical example that basically summarizes the model somewhat. And this is an example here where we have 10 investors, and this is their coefficient of risk aversion. Investor 1 is the lead investor. He has a coefficient of risk aversion of 0.8, and investor 10 is the most risk averse one, and he has a coefficient of risk aversion of 9. Each investor contributes 10. Yeah, they each contribute an equal share, and their total net worth of the firm at startup is therefore 100. This is here their outside lifetime utility. This is the lifetime utility that investor 1 can achieve by running this firm on his own with the capital he has, the 10. And this is the lifetime utility that these other investors have if they were to invest their firm in a their capital 10 in a savings account. Yeah, so this is a benchmark. Now, this is here, we now look at two scenarios. One is where the co-investors have zero bargaining power, and all they therefore could do is generate on their own the risk-free rate, an asset with a Sharpe ratio equal to 0. The other example is where the co-investors have all the bargaining power. It would be a situation whereby, say, the lead investor has, say, no capital, and where his project is just an idea. So once the co-investors have heard about it, they can just walk away and just kind of do it on their own. So they have all the bargaining power, and therefore their psi will be equal to psi 1. And then, of course, you could have everything in between, but we're not going to look at that. We just look at these two polar cases. If the investor, the entrepreneur, has all the bargaining power, you can see that he will get a utility rate of 73.5%. So he will really have the dominant voice. And the other investors have a very small weight, ranging from 3% to 7%, 6%, 4%. And the most risk-averse investors has hardly no say, no weight. Yet their lifetime utility of the co-investors will be exactly equal to what they could achieve on their own. They're exchanging a safe asset for a risk investment, but they will achieve the same, because the most risk-averse investors will be protected on the downside. Even though private equity is risky, the contract is such that they will have the same return as if they would get from investing in a safe asset. You can see here the net worth claim of the lead investors, which is 55, even though he only invested 10. Investor 10, for instance, invests 10, and he has a net worth claim of 7. That's like his book value claim. So all of them are having to pay a premium. So in other words, actually, their net worth claim is trading at a discount. Whereas the other guy here has a positive premium. He's gained from getting these people on board. And that's just because he's offering them a superior asset. Now, if you look at the other polar case, that's where the co-investors have all the bargaining power. You can see now that their net worth claim is now exactly equal to 10. So everyone basically has a net worth claim that is exactly equal to what they invest, and no one has a premium. Neither the lead investor, because he cannot extract any rents here from the co-investors. And everyone is kind of indifferent between investing in the project or not investing in the project. You can see that the lead investor has the same lifetime utility as what he would have on his own, but all the other investors are going to experience an improvement, because rather than investing in a savings account, they now can invest in a superior asset. And you can see also now that the utility weights, or the ownership stake, so to speak, is much more evenly spread. The entrepreneur now has a weight of 7.6%. The second one has 10%. This one here has 18%. And the most risk-averse investor, again, has a very small weight. So let me conclude, because I see my time is up. So what we have is a model for a private firm. And we know that for a private firm is run by a small group of investors rather than 1,000 shareholders. The question then is, will this behavior of the group, will it be like an average of the investors' behavior, which is like the diversification of opinions hypothesis, or will there be like a dominant investor? What we show is actually can be something of both. In normal times, it's very much like a weighted average of the decisions of the various investors, proportional to some extent to the share they have in the firm. But when things get really bad or really good, then things can shift towards the coefficient of risk aversion of the least risk averse investor or the most risk averse investor. And that reflects the fact that the risk aversion of the group as a whole is time varying. It goes down in good times and it goes up at bad times, even though each member themselves have a constant relative risk aversion level. The heterogeneity in risk preferences will also generate a time varying leverage level. The leverage level will go up and down over time. It's actually going to be procyclical. It goes up in good times and it goes down in bad times. At the startup, typically, the firm is going to be initially all equity finance and will hold a net cash balance. But as things then improve and money gets generated, profits get made, what we will have is that basically the firms will start borrowing more and more. But in bad time, the firm will delever in order to avoid bankruptcy. This company will never go bankrupt because it will delever and start accumulating cash in bad times. We've shown that the contracts to each investor and their optimal compensation depends on their risk aversion level. More risk averse agents will have a safer contract, something that looks a bit more like debt, so to speak, whereas less risk averse investors will have something that looks like preferred equity or even like straight equity for the entrepreneur. So these contracts are all there on the liability side endogenously. We've shown that heterogeneous preferences can lead to distortion in the ownership concentration. Often more risk-averse agents may be somewhat at a disadvantage, and the cash flow rights and control rights are not proportional to the utility weights and neither proportional to the amount put in. The exception is if everyone has utility, log utility, then things become very easy. Now, we've also shown that these dynamics in this group optimal policy and this rich diversity in these corporate liabilities, you know, having preferred stock there, straight equity and all the rest of it, that this is basically a result of agents not being able to trade their claim. So it's a compensation, it's a substitute for agents otherwise buying and selling stakes in the company. They can't do this now. And because of that, what we have is a more rich diversity of liabilities, which are tailor-made to the preferences of the investors. And finally, we've also shown that one effect of the fact that agents are unable to trade their claim, it means that co-investors will end up paying a premium for joining the firm, and they are going to be locked in. They are locked in not because they are not allowed to take their money out, but actually they wouldn't want to take their money out. In order to access the private equity, in order to get a stake in it, they have to pay like a fee. They, the private equity get issued at a premium, and once you've paid that fee, you're hoping in return for that fee to get access to superior returns in the future delivered by private equity. It's often said private equity on average, yes, will give you higher returns than public equity, and certainly there are many other assets. But in order to get access to that, you have to pay a fee for it. And once you've paid that fee, you're in, you will not then want to go out, because then you will forego these superior returns. So I see time is up. So that's pretty much it. So I'm happy to take any questions from the audience.
Thank you very much, Bart, for an interesting presentation about the dynamic of financial policy and group decision in private firm. I myself learned a lot from your speech. It is now time for the Q&A from the audience. If you have any question or want to raise a point for discussion, please raise your hand, or you can unmute and speak directly to the speaker, or that type in the chat box, and we will read out the question. Please, any question from? Yeah, I have someone that from the audience, Nguyễn, right?